now, former Reagan economist Art Laffer and Market Rebellion CEO Marc LoPresti. Great to have you both here. Marc, I got you here in person, so let me ask you, can this market rally sort of Thanksgiving through the holiday season?
It can and it will. The Santa rally is coming. Thanks for having me, and happy Thanksgiving Eve to you and Thanksgiving to the entire Fox family. And we hope Liz gets over her cold quickly. It will. And don't look at today's sell-off. This is minor. You gave us the perfect setup, Taylor, of where we were coming into this Thanksgiving Eve. Are you surprised to see a little bit of profit taking? Are you surprised to see traders that want to go into the holiday without big overnight positions taking some profit? Of course not. Fret not. Santa's coming, and so is the rally.
So, Art, I want to come to you. I think the big news for me overnight was Kevin Hassett on the National Economic Council. How confident are you that he can really start to bring down prices and get us back to 3% GDP growth?
I don't know if he can bring down prices or not. That I don't know, but I know he's probably one of the best economists in the country. I followed Kevin Hassett's work, and he's really good on policy, how to implement policy, and what the consequences will be. When you look at the Tax Cuts and Jobs Act that President Trump did in his first term, it was Kevin Hassett's work on that, corporate tax rate reductions, and how the economy responds, that was the basis for all of those estimates and all of those policy decisions. I just am really, really, really pleased with Kevin Hassett as being the new NEC chairman. Larry Kudlow was the best ever back in the first term, and Kevin Hassett's just phenomenal and will be a great chairman there of the group.
You don't have to tell us twice about Larry, because he's obviously a friend of Fox Business. So we'll let you get away with that one, Art, and we agree.
Well, he's my best friend. He's as good a friend as I have in the world, and for as long a friend. I mean, you know, no one's as old as I am, but Larry's just great. But Kevin is also terrific.
Yeah.
And in fact, you've had him on the show. A lot of the Fox shows have had Kevin on, and he's just a really articulate, straight shooting, and great academic. He's got some phenomenal academic articles, especially on corporate tax cuts and the implications with median wages and responses. So he's as good as they come.
Marc, talk to us about corporate taxes. How much is the market or not baking in what could be significant corporate tax cuts next year?
The market is generally baking in a very, very favorable environment for business, right? You've heard, I think it was Wharton that said that Trump is expected to be the most pro-stock market president ever. In the first President Trump term, we saw unbelievable all-time highs. 136 companies exceeded all-time highs during the first administration. And look, has the market priced in that 15% corporate tax cut yet? No. I think we're anticipating it, but I think a lot of what's going to continue that Santa Claus rally through the end of the year is an expectation that, in general, most sectors are going to be doing a lot better under President Trump in a second term.
Art, I just came off of a really interesting conversation with Steve Forbes in the 1 o'clock hour, and he said when we talk about the Federal Reserve, we won't be talking about whether they should cut or not, or whether there's Fed independence or not, but the models, how the models got it so wrong, how all of the think tanks told us that inflation was transitory, that we need to really rethink sort of the Federal Reserve in terms of how they're measuring and modeling this stuff. Do you agree?
Oh, totally. Steve Forbes is exactly on target there. It's not only how they model and do it. They've got a wrong conception of what the model should be. The Fed should be controlling the monetary base, period. It should not be intervening in the interest rate markets unless it wants to change the monetary base, the balance sheet of the Fed. And this is exactly the way Volcker did it back then, and Powell is the exact opposite. He's trying to change interest rates, lower, raise interest rates without regard to the monetary base. And that's a big, big, big mistake. And Steve Forbes and I both would like to see them use the monetary base to control inflation, not to try to use interest rates. Let interest be what they may, and then control that monetary base, and sooner or later that inflation will come down. And they haven't done that, and they should have done it, and by now we would be an inflation-free country if they had done it correctly.
They're still thinking, though, of maybe cutting in December. Should they be rethinking that?
Yeah, well, they should rethink their whole model. They should let market rates be set by the market, and then control the monetary base to try to control inflation. The Volcker did it with regard to spot commodity prices. If they were rising too rapidly, they would sell bonds and contract the monetary base. If inflation was not rising too rapidly, they should let the monetary base grow normally. And if it was falling too rapidly, they should expand the monetary base and let it be a long-term policy to sort of guide the price level of the U.S. to be exactly at zero. That's what they need to do. And they don't do that. They try to set interest rates with regard to the short period, and it's wrong, wrong, wrong. And that's why we had such a big problem before. But Steve Forbes is the world's expert on this, and you know, he's just completely correct, Taylor, just completely correct.
So, Mark, I want to come to you on this, because when we talk about the Federal Reserve, at the end of the day, I'm thinking about consumers at home.
Sure.
And we've heard a lot from the retailers. Best Buy was one of them. You have some notes in here about some of the losers being Dollar Tree and Dollar General as well.
Yeah.
Are these worries about tariffs or real worries about a low-income consumer still very much under pressure?
So it's both. And first I have to say, I totally agree with Professor Laffer, and he's one of the best conservative economists. Grew up watching and listening. It's a pleasure to be on with him today. It's both things, right? The lower-end consumer is continued to be stretched thin by inflation. If we look at consumer credit card debt, $1.14 trillion, another all-time high, unfortunately. Trump tariffs, yes, expected to disproportionately hit the deep discount lenders as they source a lot more of the goods on the shelves from China and other places that may be disadvantaged by Trump's tariff policy, seeking to create more of an equilibrium, by the way. So we'll see how that all pans out. And then on the other side, the higher income consumer who's feeling pretty wealthy these days, right, because of the stock market's continued rally, because of home prices, because of a lot of things. They're out there. I mean, look, for that personal income print, which was the most interesting part of today's PCE, it was double expectation, double, not slightly, but double. So those things are what is making us believe that for the retailers in the right part of the market, specialty retail, higher end retail, they're going to do, they reported well for Q3, but wait until they give you those Q4 numbers. Holiday spending is upon us.
Nordstrom's, I see, one of those,
Yes.
Abercrombie and Fitch.
Yes.
Mark and Art, I really appreciate you both for being here. I want to wish both of you a happy Thanksgiving.
Taylor, thank you very much. Right back at you. And thank you very much for the kind comments, Mark. And
My pleasure.
Wish Liz a good health.
Yes, well, we all are. She'll be back soon. Meanwhile, we have some breaking news. The U.S. is